Peter maxes out his 401k. Chris puts the same money into an HSA first, then his 401k second. Same salary, same employer, same 40 years of work, same market returns down to the decimal. On paper, for the first decade, Peter looks like the responsible one, and Chris looks like he's overcomplicating his life for the sake of a few $100s a year. And yet, by the time both men retire, Chris has tens of thousands of dollars more in spendable money, and it's not because he picked better funds or timed anything or got lucky. It's because of one feature buried in the tax code that almost nobody uses correctly. I know that sounds like a stretch. Let me earn it. By the end of this, you're going to understand exactly why the HSA might be the single most powerful account you have access to, why almost nobody maxes it first, and the one situation where doing this would be a genuine mistake. Quick disclaimer before we go any further. I'm not a financial advisor. This isn't financial advice. This is for educational purposes only, and your decisions are your own. Now let's actually meet our two guys, because the whole thing lives in the details. Peter and Chris are both 30 years old. They both make $80,000 a year. They both have access to a 401k with a typical employer match. They both have access to a high-deductible health plan that comes with a health savings account, the HSA. They are, for our purposes, the same person making one different decision. Peter does what almost everyone does. He looks at retirement, he sees the 401k, he funnels his savings there, and he treats the HSA as a little checking account for doctor visits. Money goes in, money comes out the same year, nothing builds. Chris does something that sounds almost backwards. He still gets his full 401k match, because turning down a match is just lighting money on fire. But after that match, the next dollars he saves go into the HSA until it's completely maxed. Only then does he go back and put more into the 401k. That's the entire difference. One guy maxes the HSA first, one guy ignores it. Hold that in your head, because everything that follows is just the consequence of that one choice. Now here's where I have to explain why the HSA is even special, because if you've only ever thought of it as a medical piggy bank, this is going to reframe the whole thing. Every retirement account you've ever heard of gives you 2 tax breaks at most. A traditional 401k lets you deduct the money going in, but you pay taxes when it comes out. A Roth lets the money come out tax-free, but you already paid taxes on the way in. You get the front door or the back door. You never get both. The HSA is the only account in the entire American tax code that gives you both doors and the hallway in between. The money goes in tax-free, it grows tax-free, and as long as you use it for qualified medical expenses, it comes out tax-free too. 3 tax breaks stacked on top of each other in one account. People in the personal finance world call it the triple tax advantage, and it is not marketing language, it is literally how it works. Let me say that again because it's the whole ball game. Same instrument, 3 tax breaks. There is nothing else like it. So why doesn't everyone slam every dollar into it? A few reasons, and they're worth being honest about. The first is that the contribution limits are small compared to a 401k. For the 2025 tax year, an individual can put in $4,300 and a family can put in $8,500, with an extra $1,000 for people 55 and older. Compared to the $23,500, you can put in a 401k. That feels almost trivial. So people glance at the small number and assume it's a small deal. That's the first trap. The second reason is that the HSA is tied to a high-deductible health plan, which means you have to be comfortable carrying a higher deductible before insurance kicks in. For some people, that's a real risk, and we'll come back to it, because this is exactly where the honesty has to live. And the third reason, the biggest one, is that almost nobody invests the money inside the HSA. They let it sit in cash, earning basically nothing, spending it down every year on copays and prescriptions. And an HSA used like a spending account is just a mildly tax-advantaged checking account. An HSA used like an investment account is a stealth retirement weapon. The account is the same, the behavior is everything. So let me show you the scoreboard, because numbers are the only thing that actually settles this. Let's give both Peter and Chris the same $8,500 a year to work with above their 401k match, a family HSA limit, and let's assume a 7% average real return, which is roughly what a diversified stock portfolio has returned over the long run after inflation. Peter puts that $8,500 a year into his traditional 401k. The money goes in pre-tax, which is genuinely good, it grows, and over 35 years until he's 65, that stream of contributions grows into roughly $1.2 million inside the 401k. That's a real number, and it's a great outcome. But here's the part Peter forgets. That million plus is not actually his. Every single dollar he pulls out in retirement is taxed as ordinary income. If he's in even a 15 to 22% effective bracket in retirement, a couple $100,000 of that balance quietly belongs to the government. He just hasn't paid the bill yet. Now Chris puts that same $8,500 a year into his HSA, invests it in the same funds, same 7%, same 35 years. He ends up with roughly the same balance, call it $1.2 million, because the math of compounding doesn't care which account it's happening in. But here's the part that should make the hair on your neck stand up. When Chris pulls that money out for medical expenses, and we'll talk about how realistic that is in a second, he pays zero tax, not a reduced rate. Zero. Same contributions, same returns, same time horizon, same ending balance on the screen, and one of them is worth meaningfully more in actual spendable dollars, because the other one has a tax bill stapled to it. That's the whole thing. Now I can hear the objection forming, because I'd be thinking it too. You're saying, Chris, that's cute, but I'm not going to have $1 million of medical expenses in retirement, so that tax-free withdrawal is useless to me. This is the single most important misunderstanding about the HSA, so stay with me, because the answer is wilder than you'd expect. First, you almost certainly will have enormous medical expenses in retirement, whether you want to think about it or not. Fidelity has estimated for years that an average 65-year-old couple retiring today will spend somewhere around $300,000 on healthcare over the rest of their lives, and that doesn't even include long-term care. Medicare premiums alone, which you can pay from an HSA, add up to a serious number over a couple of decades. So the idea that you won't have qualified expenses to soak up that money is, for most people, simply not true. But here's the part nobody tells you, and it's the feature that turns the HSA from good into absurd. There's no deadline on reimbursing yourself. Let me explain what that means, because it's genuinely strange. Say that this year, at 35, Chris pays a $1,200 dentist bill out of his regular checking account. He keeps the receipt. He does not touch his HSA. He lets that money keep growing. 25 years later, when he's 60, he can pull $1,200 out of his HSA completely tax-free to reimburse himself for that decades-old dentist bill. The IRS lets you do this as long as the expense happened after you opened the account and you never claimed it elsewhere. So every medical receipt you save becomes a little tax-free withdrawal token you can cash in any time in the future, after the money has had decades to compound. That's how a person who only ever has, say, $200,000 of lifetime medical expenses can still pull hundreds of thousands of dollars out tax-free. They're not pulling out money for today's expenses. They're cashing in a lifetime of saved receipts after the underlying dollars quietly grew tenfold. Once you've seen that, you can't unsee it. Now let me be fair, because if I only showed you the upside, I'd be doing exactly what the get-rich-quick crowd does, and I want to earn your trust, not just your attention. So let me make the strongest possible case for Peter, the 401k first guy, because it's a real case. Argument 1 for the 401k. The match. If your employer matches your 401k contributions, that matches an instant guaranteed return that no HSA can touch. A 50% match is a 50% return on day one before the market does anything. So the 401k absolutely should come first, up to the full match. Chris knows this. That's why even he funds his match before he ever touches the HSA. Anyone who tells you to skip your match to fund an HSA is wrong, full stop. Argument 2 for the 401k. The contribution limit is just bigger. If you can save $30,000 a year, the HSA can only absorb a fraction of that. At some point, you run out of HSA room, and the 401k and IRA are where the rest has to go. The HSA isn't a replacement for those accounts. It's a layer that goes in front of them. Argument 3, and this is the honest risk. To have an HSA, you have to be on a high-deductible health plan. If you have chronic conditions, a family that needs frequent care or expensive ongoing prescriptions, that high deductible can cost you more in out-of-pocket spending than you'd ever save in taxes. For some people, a lower deductible plan with no HSA is genuinely the smarter, safer choice, and I'm not going to pretend otherwise. The triple tax advantage is worthless if the underlying health plan bankrupts you in a bad year. So this is not a universal commandment. It's a conditional strategy, and the condition is that the high deductible plan actually fits your health and your life. I want to be careful about that because the internet loves turning a good idea into a one-size-fits-all rule, and that's how people get hurt. Okay, so let's say the high deductible plan does fit you, your health is reasonably stable, and you've got an emergency fund to cover that deductible if a bad year hits. Now, what does the actually optimal order look like? Here's the sequence that the math keeps pointing to. First, contribute to your 401k up to the full employer match, because that guaranteed return beats everything. Second, max out your HSA, because the triple tax advantage beats your remaining 401k and IRA contributions on a pure tax efficiency basis. Third, go back and finish maxing your 401k or a Roth IRA with whatever you have left. The HSA isn't first in line overall, the match is, but among the things you actually have to choose between, the HSA quietly wins the efficiency contest almost every time, and that's the part that gets skipped. Now, here's the behavior that makes or breaks the entire strategy. And I need you to hear this because it's where 90% of people go wrong. You have to invest the money inside the HSA, and you have to pay your current medical bills out of pocket if you possibly can. Most people open an HSA and leave the balance sitting in cash, earning a fraction of a percent, and they swipe the HSA debit card every time they go to the pharmacy. If you do that, none of what I just described happens. You get a small tax deduction and nothing else. The magic only shows up if you let the money stay invested for decades, and you save your receipts instead of spending the account down. The account is the same for Peter and Chris. The only difference is that Chris treats it like an investment and Peter treats it like a debit card. Same instrument, completely different outcome. Let me put a real number on the cost of getting this wrong. If you contribute the family max every year, but leave it in cash, earning effectively nothing, instead of investing it at 7%, over 35 years, you're looking at a difference of well over $800,000 between the two outcomes. Same contributions, same tax advantages, and the only variable is whether you press the invest button. That's not a rounding error. That's a house. That's most of a retirement. The triple tax advantage is the headline, but compounding is still the engine, and an uninvested HSA has the engine switched off. Now let's talk about the edge case, because a good plan survives the bad scenario, not just the good one. What if you need the money before retirement and not for medical reasons? Here, the HSA has a clever escape hatch. Before age 65, if you take money out for something that isn't a qualified medical expense, you pay income tax on it plus a 20% penalty, which is harsher than a 401k's 10% penalty. So you don't want to do this casually. But after age 65, that penalty disappears entirely. Once you're 65, you can pull HSA money out for any reason at all, and it's just taxed as ordinary income, exactly like a traditional 401k. So in the absolute worst case, where you somehow never have a single medical expense and never saved a single receipt, which is essentially impossible, your HSA simply behaves like a regular 401k after 65. It can't actually do worse than the account everyone already trusts. The downside is capped at being as good as a 401k, and the upside is tax-free money for life. That's an extraordinarily favorable trade, and it's the part that should make you sit up. What would have to be true for Peter, the 401k only guy, to actually come out ahead of Chris? You'd need a world where Chris has zero lifetime medical expenses, saves zero receipts, and somehow gets taxed more harshly on HSA withdrawals than on 401k withdrawals, which can't happen because after 65, they're taxed identically, and before 65, the HSA can be fully tax-free. There is essentially no realistic universe where maxing the HSA correctly loses to ignoring it, as long as the high-deductible plan fit you in the first place. That's why this isn't really a close call once you understand the mechanics. It only looks close in the first 10 years, when the dollar amounts are small and the tax-free withdrawals are still decades away. So which path are you going to take? Because there are really three. The first path is the hype path, where some account hits the algorithm and people scream that the HSA is a secret loophole that makes the 401k obsolete and you should dump everything into it. That's wrong. It ignores the match, it ignores the contribution limits, and it ignores people whose health makes a high-deductible plan a bad fit. Dismiss that path. The second path is the cynical path, the one that says this is just another optimization that only matters if you're already rich, that the limits are too small to care about, and that you should just throw everything in the 401k and stop overthinking it. That path is comfortable, and it quietly costs you a fortune in taxes you never had to pay. Dismiss that one too. The third path is the quiet one. You check whether a high-deductible health plan actually fits your health and your family. You make sure you have an emergency fund to cover the deductible. You get your full 401k match first. Then you max your HSA. You invest every dollar of it instead of leaving it in cash. You pay your medical bills out of pocket when you can. And you save your receipts in a folder like they're tiny tax-free lottery tickets, because that's exactly what they are. You don't have to be a genius to do this. You just have to do the boring thing on purpose for a long time. Run your own numbers with your own salary, your own health situation, and your own match, because the right answer is specific to you, not to a YouTube video. But whether you ever optimize a single account or not, take the habit with you. The habit of asking not just how much am I saving, but how much of it will actually be mine after taxes. That one question changes everything. Quick reminder, I'm not a financial advisor. This was for educational purposes only, and your decisions are your own. If this helped you see the HSA differently, hit subscribe and drop a comment telling me which one you are right now, the Peter who's been swiping the HSA card or the Chris who's been saving the receipts. Thanks for watching, and I'll see you in the next one.